New markets news. Asian markets also closed lower on Thursday as investors remained concerned about China's increasingly bleak economic growth outlook. The world's second largest economy has been hampered by continuous coronavirus outbreaks, a property crisis, and a lack of room for monetary policy easing. The Hang Seng closed at 0.88% lower, dragged down by the consumer discretionary and material sectors, while Japan's Nikkei lost 0.96%, closing at 28,942 points. Over in the United States, the S&P 500 and Nasdaq ended higher as an upbeat sales forecast from Cisco Systems helped to lift the technology sector, while data showed the economy remained relatively strong. The S&P 500 gained 0.24%, the Nasdaq Composite gained 0.21%, and the Dow Jones Industrial Average rose 0.6%. Let's take a look at how the markets are performing today. The rand is trading at 17 rands 1 cent to the dollar, 20 rands 15 cents to the pound sterling, and 17 rands 11 cents to the euro. The JSE is mainly lower at this hour. All share index are falling 1% to 70,323. The industrial 25 index is losing 0.25%. Financials have shared over 1%. Markets in Europe also trading lower. Britain's FTSE 100 is flat. The CAC 40 in France has shared over 0.5%, and Germany's DAX is 1% weaker. Looking at the commodities, gold is trading as $1,572 and platinum at $900 per ounce, while the price of Brent crude oil is at $94.63 a barrel. Our market commentator for today is Warwick Lucas, and no stranger to the market segment. Warwick, welcome. He is, of course, from Galileo Securities. Thank you so much for joining us once again. Let's start with the week that was, looking at retail sales. Obviously giving an indication of consumer finances and how those took place, particularly in that month of June.
So if we look across the retail sales, I mean, broadly it's been looking quite positive, and in fact, if one looks across other consumer type stocks, I mean, the likes of Caxton, Adcock Ingram, for example, even other players such as your Workforce Holdings, which is a recruiting company. I mean, what we're seeing is a recovery in some consumer confidence, even despite the higher interest rate cycle. So broadly, I suppose you could say that from the consumer point of view, with a small uptick in employment, and generally the country going from bad to less bad in terms of the consumer experience, I think we're seeing a nice little pickup there. Of course, sustainability is going to be another issue.
Yeah, let's take a look at data to look forward to next week. The quarterly labor force survey, obviously giving us an indication on how jobs are faring there, and another one to look out for, inflation as well as PPI. What are your predictions at Galileo Securities?
Okay, so I think the quarterly bulletin is a fairly comprehensive document, so I'm not going to enter that one. But in the case of CPI, I mean, we're looking at inflation probably increasing yet again, I'm sorry to say, from last month's 7.4% annualized to about 7.8%. So, and then of course PPI, which is the inflation that businesses experience at the factory gate, is likely to tell quite an ugly story with an increase there from 16.2% to 17.6%. And those big differences between PPI and CPI suggest that business is going to be absorbing quite a lot of input cost pressure just in order to keep businesses ticking over. So certainly the inflation cycle in SA stays quite tough. And of course, while the rand has been so weak, that keeps it that little bit tougher, because typically, of course, the rand is a shock absorber, but a weak rand is indeed inflationary.
Speaking of that weak rand, we see that now it's just gone weaker at 17 rand 1 cent. Should we be concerned, or could it be linked to dollar strength?
Well, a bit of both. I mean, the rand obviously is a very volatile currency. In the previous week, the commodities certainly played ball with the rand. I mean, the rand had put in a nice recovery, went back to nearly 16, around about 16 to the dollar, but back we came this week, and yet commodities not softening that much. And I suspect part of that coming through is actually the concern about the very cloudy prospects for China's economy, which certainly continue to fumble and bumble around the COVID issue.
Right, it's a very good time for banks. We've seen other banks who have reported in the past, such as Nedbank and ABSA, reporting, a good set of results. Standard Bank has followed suit today. What do you make of what's happening in the Standard Bank, or rather in the banking sector right now, given that banks are reporting such pleasing set of results?
I think a good part of it is really how bank earnings are made up, which one can get quite technical about. But the bottom line is that banks basically borrow from you and me on our cash accounts, and they lend it out to home loans on very long-term loans. So when you've had the likes of the long-term interest rate market just continuing to stay very, very high rates, it means that banks wind up being quite or very profitable in those sort of circumstances. So even though consumers, albeit positive, are not rampant, it still translates into very positive earnings for the banks. So they're quite a bit different from the rest. But I think obviously the banks would also like to see the rand a little bit firmer than it is.
Naspers releasing its results. They're planning to spend 1.5 billion euros buying a further stake in iFood in Brazil. Do you think this is a step in the right direction?
Okay, so just in terms of the results, that's a flow through from Tencent, which was a little bit of a downer in a way. I mean, Tencent showing some slightly flat to negative revenue there. I mean, but it also highlights, of course, that China, as previously discussed, is a problem. I mean, with the fumbling handling of COVID and so on, which means that if Tencent, if Naspers and Prosus get good earning streams elsewhere, that's a positive diversification from China, which obviously they're very, very exposed to. So obviously it's going to be price dependent, but perhaps it is a reasonable step to take.
Yeah, let's take a look at how those minutes from the Federal Open Market Committee last night, how they just echoed Powell's July's meeting comments. But I see that the S&P still failed to budge through the key technical level. Do you think this is due to a market pullback of sorts?
Well, I think what we're looking at really is that with a lot of the high inflation that's been occurring, certainly in the States, is what you call cost push, which is things like oil prices coming through into petrol and metal and commodity prices coming through to a lot of manufactured goods. And a lot of it is sort of transitory or temporary in nature. But the problem is it was so broad that it might have led to inflation becoming sticky in other areas, for example, services. And what that means is that the glide path or the way in which rates change, that obviously the market will be looking for to mid-2024 might actually wind up being in a slightly different resting place from what they're actually hoping. And that, of course, means that if indeed the current projections and prognostications are wrong, there's certainly a lot of opportunity for a surprise. And in any case, the data being used to project a rollover in interest rates actually it's a relatively short data set. I think we've still got to see genuine confirmation coming through there.
Warwick Lucas, always great speaking to you. I know that Anastasia is probably going to be back next week to speak further to you and look at what's happening in the markets next week. But thank you so much for making time to speak to us. That's what your market update. We take a quick break now. Don't go away. More news after this.